Unlike your normal day job, where you probably have 10, maybe 15 tasks that you have to manage daily, as an options trader, you only need to understand 3 main strategies. And with enough practice and skill, these could allow you to leave that lousy, stinking job that you have. I'm Robert Roy, a full-time trader and trading coach and founder of WealthBuildersHQ.com. We teach technical strategies to build your wealth using the financial markets. And in this video, I'm going to show you 3 main option trading strategies you must, not should, must know to call yourself a professional options trader. So the very first strategy is the simplest one. It is buying calls and puts. Now, a quick reminder of what calls versus puts are. I want you to think of your phone, okay? And if you want to make a call, you would pick up your phone to make a call, right? So with a call, you pick your phone up. When you buy a call, you want the stock to go up. When you are done talking on the phone, you will put your phone down. When you buy a put, you want the stock to go down. In essence, that's what a call and a put is. When you buy a call option, you believe the market is going to, or your stock is going to move up, bullish. You buy that call option with the expectation the stock increases in value, which means your option will increase in value. When you buy a put, you think the market's going to go down. Now, this is kind of turning your hat backwards, right? Where you buy a put and the stock goes down, but you make money. Yes, because the stock price dropping increases the value of the options. Next is open interest, right? We want to have a minimum of 100 open interest on our position. Why? Well, how many of you like to go to parties? I do. How many of you like to be the only one at the party? No, unless it's a pity party, probably not. Well, if you have no open interest or very low open interest, you just showed up at a party that has 4 people in it. Yay! Not my kind of party, right? I want to have a lively party. I want interest in that party, hence the name open interest. How many contracts are open in somebody's hands right now? We want to have a minimum of 100 contracts open, all right? And that is not hard in this options market. And if you're a newer trader, forget anything that doesn't get near there. If you're more experienced and you know how to trade around some of that, maybe. But I would say for the most part, everyone should focus on stocks that have open interest of 100 or greater. Now we look at Delta. What the heck is Delta? Is that like from Delta Force? Isn't that a movie with Chuck Norris, right? No, it's not Delta Force. It's Delta. Delta is a Greek term, right? And it helps us understand how much the option price will move for every dollar the stock moves. So as an example, if we have a delta of 70, every dollar the stock moves up or down, my option will move 70 cents. This is what helps us to understand when there is a small movement in the stock price, there is a magnified movement in the options price. Now we look at a delta range of 65 on the low end to 85 on the high end. But I will always trade closer to 65. It costs me less, which means I have less risk in the trade. And because of the way a bell curve works, hopefully I drew that right. Did I draw that right? Tell me down below. All right, the way that bell curve works, right? We're in the sweet spot on that bell curve with that 65 to 85, but much more so with 65 because we are on a really nice place in that curve and gives us the largest possible gain when the stock starts to move up. Now, when we look at pros and cons of trading options, the pros are I don't need a lot of money. I don't have to buy the stock. I never have to buy the stock. I have a limited amount of risk. The cons are it has to move in my direction and that option expires. If you bought a weekly option and you buy on Friday and it expires, or you buy it on Monday and it expires on Friday, think about it. You've got 5 days. If you're wrong and you do nothing with it, you could lose everything that's in that trade. Similar to a stock, where if you do nothing, you could lose all of your money, right? It's called Enron. If you're not sure, look it up, right? You could lose all your money, but with options, you have a very defined time where a stock, as long as that stock still trades, you still own it. Now, strategy number 2 is called covered calls or renting out your stock, right? Now, it's a good strategy for your retirement account and building wealth off of securities that you already own. So first off, what is a covered call? Well, it's a way that you can rent out your stock. Say what? You can, wait, no, Rob, you can't rent stocks out. Well, yeah, you actually can. No, you can't. Oh, no, you can. It's called a covered call. You see, you have to think of it. It's not like you call the broker and say, I want to rent out my stock. And they're going to go, good for you. No, it doesn't mean that, okay? But what you're doing is this. You own a stock. You bought a stock, let's say, at $20 a share, XYZ stock. You sold a call, let's say the $22 call, and you gave someone the right to take your stock away at $22 that you bought at $20. Okay, so they're going to take it away if it gets to a higher price. So it's like setting a target up, right? Well, no, not really. Because if it never gets to the 22, do they have to buy it from you? No. Can they buy it from you? Yeah, but if it stays at 20, are they going to buy it at 22? Probably not. Well, what if they did? What if they took it away at 22? They're just real ding-dong. They don't know nothing about money. They took your stock away at 22 while it's trading at 20. Are you going to be angry? No. I had it happen one time. I called the broker and said, is there a list? I'd like to do this again. Can you get me back on that list? I'll buy the same stock if they'll buy it at a higher price from me. Right? You're renting that stock out, giving somebody the right to take it away from you, which means if they have a right, you, as the trader that sold that option, you have the obligation. All options have rights and obligations. Right? They could take that stock away from you at any time. On or before whatever the expiration date is, a week later, a month later, up to 6 weeks is the maximum you should look to ever sell. I sell as short of time as possible. Today is a Friday. I looked already today to sell my options for next week. Now, it's a great strategy for your retirement account and building wealth off of securities that you already own. Here's why it's so great for a retirement account. Your stock has a cost basis to it, right? And if you buy that stock and the stock appreciates over time, you need to track when you're writing covered calls and all of that. There are legalities of tracking them in non-retirement accounts. It's not a big deal, but it's just a better investment in your retirement account, and particularly if it's a Roth where it grows tax-free, right? You paid the taxes up front on the investment and you pay nothing on the gains. To me, that's the home run, folks, is right there. I do this day in and day out in a program that I have called Covered Call Explorer, where we go through 5 major ways of selling calls. One is on the stock, some are on the options, but there are 5 different strategies like this. Now, you can find it in the description below. Go ahead and check it out. And there is a 2-week trial. So what that means is for the next 2 weeks, you're going to get all of my candidates, all of them, for those 5 covered strategies for free. No obligation on your part. The last strategy that you should know is selling credit spreads. Now, there are different kinds of spreads. There are vertical spreads, diagonal spreads, calendar spreads, iron condors. There's the upside down Flint rubble bubble cake spread, right? There's all kinds of names and funky things that people have put together, right? But the main ones are going to be the ones I mentioned: vertical, diagonal, calendar, and then, of course, you've got an iron condor. My focus, your focus, should be on vertical spreads. Things like credit spreads. I love credit spreads. Debit spreads fit there as well, but I like getting paid a lot more than I like paying out. So I like credit spreads a whole heck of a lot more than debit spreads. I love them on newsy strategies. Bull put spreads, bear call spreads, magnifique. They are great on those news announcements. So basically how the trade works is this. Let's say the stock is moving in a bullish pattern. And you have a support level here at 100. And the stock is just above that, 102, 3, it doesn't matter. It's just above the 100. I am going to come down here and say, okay, I'm going to sell a naked put, maybe the 95. So if this is my support, forget about the numbers for a second. Excuse me. I'm going to sell a put somewhere down below support. Well, that means I take on an obligation, yes. But it also means if I just go ahead and I buy a put just below that, I now took on an obligation here, and I have an insurance policy here, and I've greatly reduced my risk in that trade to the point that you can have your risk down where the maximum risk, not your risk, the trade's maximum risk is only 50 cents, which means your risk is somewhere between 30 and 45 cents. That's how much you can reduce the risk in these trades. All right, so who wants a bonus strategy? Well, if you don't, you're going to get one anyway. Let's talk about going naked. Going naked puts, selling something you don't own. You see, I just kind of alluded to it in the credit spreads, right? I figured it's a good place to go ahead and really hone in on it. So selling a naked put. You believe a stock is going up. A naked put is a bullish strategy. So what do? You sell, let's say the stock's trading at 100. You sell this $95 put, and it says that someone can make you buy the stock at 95 and it's trading at 100. Well, if it's at 100, why would anybody make you buy it at 95? Exactly. But they're going to pay you a premium for that. Say they pay you $1, right? Is there risk in this trade? Absolutely, there is, right? If the stock moves down, you could have to buy that stock at a higher price or buy the option back at a price higher than you paid for that position. So how is it similar to credit spreads? Well, I kind of, again, stepped into that already. A credit spread, if it's a naked put, right, then or a bull put spread, they both start off with selling a put. Same setup. The support line is here. You're going to sell somewhere down below that level on a naked put or on a credit spread. It doesn't matter, right? Here's support. Here are my two different strategies. I'm going to sell the same exact thing on both. The difference now, when we go to naked put, it's just selling the naked put. Or on a credit spread, we sold the put and we bought an insurance policy. So we only have one thing we did on a naked put. You've got two that you did on a credit spread. You reduced your profit, but you dramatically reduced your risk in the trade. So what happens if the stock is exercised? You have to buy the stock. And then you turn around and, I don't know, maybe write a covered call, right? There's a strategy that I call Wheel of Fortune, and it literally just goes round and round and round. Here's how it starts off. Sell a naked put. Somebody pays you money. The worst thing that can happen is they make you buy the stock. If they make you buy the stock, you're going to rent it out. Okay, so on a naked put, you got paid cash. When you rented the stock out, you got paid cash. Now they take the stock away from you, right? They take the stock away. You get paid cash. You see where this is going, folks? It literally goes round and round and round. The only time that I have to pay anything is when I bought the stock. Folks, in a nutshell, that's it. Buying calls and puts, covered calls, credit spreads, naked puts. And if you understand them, practice them, and master them, you've got the potential to become dangerous in the markets. Until next time, make it a profitable day. Stay focused on the quest to becoming a great trader. Keep crushing it. And remember, you're just one trade away. And be sure to check out some of our other amazing trainings right here.